We're now moving to our policy panel on financial stability and monetary policy. I think that we have already kind of had some discussion. So, okay, so we're very grateful to our speakers, Isabel Schnabel, Mervyn, and Shin, for agreeing to participate in the panel, for moderator Sebastian Mallaby. So I would hand over to Sebastian.
Great. Well, thanks, Dimitri. It's great to be here. When I heard that this conference is going to be in honor of Charles, I said, sign me up immediately. Like everybody here, I'm a big fan. In my case, that goes back to writing a biography of Alan Greenspan and needing some advice on natural history, which Charles very generously provided. It's also, by the way, fitting that we should be having a conference on around inflation. Given that Charles's most recent book, accurately predicted this inflation problem, although he rather modestly pointed out to me just before that there were certain factors in the equation that he maybe didn't write about in this book, long COVID, Ukraine invasion. Those were not in the book, but there were still some things that were China's diminishing growth trajectory and so forth. So I think it's a very good subject and a good tribute to Charles. So we're going to start this panel by asking the panelists, you know them all already. Mervyn King is the only one who's not doing double duty, but since he ran the Bank of England for 10 years, in 2013, I think you will know him. So we're going to ask people initially to talk about inflation and how they see the picture, and secondly, we're going to go back to financial stability. Which is a continuation. Sorry, Dimitri.
Yeah, I forgot to say that the panel discussion will be live streamed.
Okay.
Thank you.
Okay. So we're going to go back to financial stability for a sort of second round, although Isabel's just talked about that and she won't talk again initially. And then we'll have questions, some from me, I hope more from you. So please be ready for the senior group. So I'm looking forward to lots of interventions from the floor. So to start it off, I'm going to go back to Isabel to start. So perhaps you could, you've talked about the stability side. What about the inflation side? How do you see it at the moment?
Yes, happy to do so. So obviously, I'm going to talk about the euro area, but not everything is different from other areas. But I think you're probably going to talk about the UK. As I mentioned in the speech already, so inflation at the beginning of the pandemic, inflation actually fell, and at the end of 2020, it was a negative territory in the euro area, and then it started this sharp decline over a long time. Until headline inflation peaked in October of last year at 10.6%, and since then it has come down to 7% as of now, and this is driven by the sharp decline in energy prices. At the same time, various measures of underlying inflation are still very high, and they continue to show a strong momentum. I mean, the most frequently mentioned underlying inflation measure is core inflation. The euro area it now stands at 5.6%, which, by the way, is well above our current policy rate, which stands at 3.25%. And our main concern is the persistence of inflation, and especially of underlying inflation. So we've seen that inflation surprised again and again on the upside. So actually, if we just look at the data that came in recently and we compare that with our March projections, we basically underestimated all inflation components except for energy. And what we're seeing is that, originally the inflation increase in the euro area was very much characterized as being supply driven. We had the supply bottlenecks, we had energy prices, but there was this transitory narrative which said, oh, eventually this is going to disappear, and this is actually what we're now seeing. So these supply side factors are fading. But the problem is that by now we have seen a certain rotation from the supply side factors to more demand side factors. And in particular, we see that wage-intensive services are playing an increasingly important role. Wage growth it has picked up substantially, so there is a concern about second-round effects. We see that the unions are pushing for wage increases in order to recoup at least part of the lost the purchasing power of the employees. The firms are trying to at least protect or even increase their margins. So we are seeing that some firms are able to raise prices even more than their own costs have risen, supported by a relatively resilient economy and strong demand. And of course, this is precisely what could then set in motion a type of spiral that could worry us. In addition, fiscal policy is still expansionary. It's also interesting to compare it with the US. You know, the US had a very strong fiscal impulse during the pandemic. By the way, the euro area as well, not quite as strong, but also pretty strong. But the striking difference to the US is that that we are still having very strong fiscal impulse, which is of course was meant to buffer the energy price shock. But now that the energy prices are coming down, I mean, some measures are automatically reversed if they're linked immediately to the energy prices, but some are not. And so in the end, it seems that that fiscal policy is maybe too expansionary. We look very carefully at inflation expectations, and they are still anchored. But they, nevertheless, they are stubbornly high. So there are several measures. I mean, they don't really shift up a lot, but they are above 2%. And if you look at our projections, you see that inflation is projected to come down to target only in the middle of 2025, which would imply a period of like 4 years of above target inflation. And the question is, what does this mean for inflation expectations? And could this possibly erode the trust of people that we are actually able to bring inflation back to 2%? And these inflation expectations are important for price setting. They're also important for wage negotiations. And they can actually also lead to some persistence. So if they are today high inflation expectations, and this then enters into wage negotiations, and you have wage agreements that are there over like several that have a duration of several years, that already that implies additional persistence. And this is why it's so important that we show strong determination to bring inflation back to 2%, and that we also act accordingly. Maybe if I may, I still would like to say a few words about monetary policy transmission, because of course, now that we've done already a lot, 375 basis points, we do see first signs of monetary policy transmission. So we do see that, of course, bank lending rates have gone up quite a bit. We see in the surveys that loan demand is dropping quite sharply, that credit standards are being tightened, and that loan growth is slowing. And the question now is how this will play out in the real economy. And there's a very intensive debate whether transmission nowadays is weaker or stronger, whether the lags are shorter or longer. And there are arguments for different outcomes there. I mean, I think that the lags could be a bit longer because we have longer fixation periods of loans, could be a bit weaker because the labor market is so strong. And then one question is, what does the financial turbulence do to monetary policy transmission? So far, I would say we do not see that it has led to a massive additional tightening, but it looks like a rather, let's say, normal tightening cycle. So overall, from today's perspective, it seems that there's more that has to be done. As our president says, there's more ground to cover, so we will still have to raise rates more, and then stay also at a high level, probably for quite some time.
Isabel, I want to ask you one quick follow-up, which as a central banker, you're used to unscheduled shocks, so this should be fine. I was just coincidentally sitting next to a very senior former European central banker on Monday, and he put forward the idea that one of the reasons why Europe going into this 10-point-something% situation was a sort of geopolitical underestimation of Putin's willingness to use the gas weapon to jack up energy prices in Europe, and that sort of is the extent of the Russian preparation to use energy as a tool of war was sort of central to the miscalculation. Do you think there's anything in that? Sure.
No, I think that's true. I mean, this massive reliance on Russian gas in particular was, of course, an underestimation that it could be used as a weapon. It was actually seen quite the opposite, that this would bring stability, and that Russia could never afford to do anything that would be against Europe, because Russia also was dependent on these gas exports, but that was really a bad judgment.
Okay, Hyun, inflation, how do you see it?
Inflation, I'm going to echo a few things that Isabel said. Inflation is moderating. It's certainly lower than it was last year. But in a way, it's the low hanging fruit that's been reached. What we've seen is a reversal of that initial impetus in the rise of inflation. So commodity prices, energy and food, that's moderated. So that fed through in the lower headline. What we are seeing, though, is this replication and the supply chain disruptions, that shift into goods. That's never really happened. So it's now much more on the services side. The point is that services are much more labor intensive. So it's around, in terms of input, around twice as intensive as goods. So, and wages are much more inertial. So I think what we have going forward is a much tougher task, because I think those easily had a win for now behind it, and it's more the tougher part of getting the inertial elements down. One thing to bear in mind, which I think is also related to your previous question to Isabel, is the difference between CPI versus the GDP deflator. I think it may sound a little bit arcane, but it's important for this discussion, because when we think about the labor share of GDP and how the labor share and the non-labor share is responsible for pushing inflation or otherwise, it's more the GDP deflator. It's the price index that's applied to the value added, more broadly. But when we talk about real wages, it's typically the CPI, because that's what workers actually feel. And in terms of CPI, of course, CPI has been much higher. That was a big shock because of energy and food. That meant the real wages have fallen away quite a lot. Now, wages are growing at a pace which is roughly equal to inflation right now. But of course, in terms of level, it's fallen away. So it's we need to think about the integral of that chart rather than simply the rate of growth. We published a BIS bulletin this morning, laying out some milestones for what to look for to see whether the disinflation is on track or not. And there are two broad issues we need to bear in mind. So who's going to bear the burden of that deflation, of that disinflation? Is it going to be firms? Is it going to be the non-labor share? Or is it going to be, again, the workers? And I think, given where we've started and how far workers have fallen behind, I think it's only natural there will be attempts to pull back some of the losses, what Isabel mentioned. But the problem is, if the pullback is very rapid, and the real wage, is going to rise, well, it's going to be recouped after this initial setback. That could give rise to this kind of spiral that Isabel mentioned. I think this is where many of the speeches we've heard from policymakers really come in. This terms of trade shock that the non-energy producing countries have received. So that includes the UK, the Euro area, not so much the US. And then I'll come back to that because the US is now a net energy exporter. What that means is that someone has to bear that burden of the disinflation. And so far it's been workers, it's been the labour share that's really suffered the worst knocks. And going forward, I think one question mark is how much will the labour share recoup? And I think there's a little bit of difference between the various jurisdictions. I think for the Euro area, I think it's particularly important. I mean, that would be the kind of one risk that there would be an acceleration. But if you see an attempt to recoup the loss in real wages very rapidly, then that could actually, be a kind of spark to set in motion another impetus. Let me mention one more thing, Sebastian, because you mentioned energy. Of course, it wasn't just the energy price. It was also the exchange rate. Exchange rates are incredibly important for this because energy and food, many of the commodities are priced in dollars. Last year, what we saw was a very unusual coincidence of a strong dollar and rapidly rising prices in dollars. That's normally we see a negative correlation, but it was that double whammy that really jacked up the price in the Euro area, Japan, in other energy and food importing economies. And one of the open questions is that going to be a new trend? So what I mean by that is the previously negative correlation between commodity prices and the dollar. Could we have seen a flipping? And we published the BIS bulletin a few weeks ago that sort of hypothesizes that there could be some forces that pushing the global economy towards that direction. So one thing to really look out for, as well as the labor share, one thing to look out for is what happens to exchange rates, and in particular, will we see again the combination of strong dollar and high commodity prices? I think if that happens again, that could really be another spanner in the works.
If I understand right, you're saying that the fear of a rise in the labor share leading to a sort of wage price spiral is more acute in Europe than in the US?
Yes, I would say the rise in the labour share. I think the labour share has fallen away quite a bit. But I would say that the fall in real wages as computed by the CPI, so this is if you like, the price rises that consumers actually feel. That has been much more severe in the Euro area as compared to the US.
Mervyn.
Thank you. Well, for 25 years, central banks were quite successful at controlling inflation. Despite a lot of shocks, inflation kept pretty close to the target of 2%. And we're now in a position in which the underlying inflation rate, which I'll define as CPI inflation, excluding food and energy prices, is between 5 and 6% in the United States, in the Euro area, and in the United Kingdom. So something has gone badly wrong. The question is, what is it? I think my proposition will be that there's been a misuse of models by people in policy-making positions, encouraged, I fear, by very clever academics who've used very clever models, but lost the plot in one important respect. Now, when inflation targeting was introduced, it was explicitly as not a theory of inflation. It was a handbook of how to behave as a central banker. Be more transparent, explain things, create a narrative. But it wasn't a theory of inflation. So the question is, what would be a theory of inflation and the determination of the price level? Now, there was a desirable and understandable wish to model the frictions involved in both wage and price setting to put into a model of optimizing behavior, which described the behavior of agents and could be turned into a general equilibrium model of how wage and prices moved around an adjustment to an underlying inflation rate. And those models did not include any analysis of the actual transmission mechanism of monetary policy, because it is simply too difficult and it made no sense in an analytical model to try and put everything in it. So the banking and financial system were sort of left to one side. Well, this is unfortunate because, you know, this is the way in which policy is transmitted to its impact on the price level and inflation. But it was understandable why the model builders, trying to understand frictions, did that. The question is, how could you turn this into a theory of inflation? Well, you couldn't use rational expectations, because if you don't put in the transmission mechanism into the model, then there's nothing over which to define rational expectations. So the bright idea was thought up, but actually the thing that drives inflation is the inflation target. Well, if nothing much happens and you're close to the target and you don't make any mistakes in monetary policy, then you never see anything that's going to challenge that assumption. But if you make a mistake, then you will see it. And the idea that inflation is driven by expectations has some merit, but the idea that those expectations are always and everywhere driven by the target itself is a very strong and bold assumption. And what we've moved from, I think, is building which, when Charles started to write about this, Milton Friedman said inflation is always and everywhere a monetary phenomenon. And what we've now got are a set of models that say inflation is always and everywhere a transitory phenomenon. Because by assumption, inflation has to come back to 2%. And I remember on the Monetary Policy Committee, as Charles would in the late 1990s, and someone on the ECB board made a similar comment not long ago. When the staff do simulations of different parts of interest rates, isn't it odd that inflation always comes back to 2%? And that's because the model said it has to. Now, this is a dangerous thing to do. And you've got to have some nominal framework which pins down the price level. Real variable, no matter how clever the model in enabling you to understand friction, won't do it. And what we saw in 2020, 2021 was that an initial set of decisions to engage in some QE to deal with a dislocation in financial market was not reversed when that dislocation disappeared. In fact, it was doubled down on. And the increase in QE in 2020 and 2021 led to very rapid growth rates in broad money. Now, I know I've mentioned a word which is unthinkable to mention in discussions of inflation nowadays, which is the word money. But nevertheless, it does seem to be somewhat odd to take the view that, which the Fed did, that if you see in early 2021 that the growth rate of broad money is higher than at any time since the Second World War, that you wouldn't ask yourself the question, what's going on? You don't have to have a view that this has a mechanical link to inflation to think that you maybe have overdone it, particularly at a time when you have a supply shock that reduces aggregate supply. Why would you do QE to boost aggregate demand? And there are similar arguments which were used by Larry Summers in saying, why would you do a fiscal stimulus at a time when there was no sign of any shortage of demand relative to the lower level of supply? And one of the problems in all this, it seems to me, is that central banks have gone out of their way to deny that QE is in the first instance an increase in money. What it is, it boosts deposits of those who sold assets to the central bank. And if you see that growing very rapidly or contracting very rapidly, it ought to be on the dashboard of any central bank that is worried about either monetary or indeed financial stability, but it's been ignored. So I think my feeling is that in 2020 and 21, a mistake was made in analysing the nature of the problems facing the central banks. And that then was revealed the implausibility of the idea that you can explain inflation in a model by assuming that inflation always reverts to what your own target is. You can't say my theory of inflation is that it will stay low because I say it will stay low. That is completely circular and not very plausible. Now, after the mistakes in 2022, actually they were corrected. And the position we're in 2023, even though the word money doesn't appear in any of the analyses of the challenges facing us now, far from growing at the highest rate since the Second World War, we're now seeing money declining. And that is, I think, a potential indicator that inflation will come back down. There is no certainty in any of all this, and I think the frictions in the labour market may mean that the lags are longer than we've seen in the past. But again, we shouldn't be overlooking that. It should be part of the conversation. But I think the policy challenge in 2023 is actually very difficult. You could argue that we are probably not that far from where we ought to be if there are good reasons for being concerned about the upsides for inflation as well as now the monetary contraction. And I think my last point on this would be a plea for greater analysis of the transmission mechanism, because the risk to the intellectual framework now is that if we, as I think central banks are beginning to do in how they think about it, abandon all the ideas that went hand in hand with the assumption that inflation expectations in the medium term are driven by the inflation target, forward guidance, yield curve control, ideas of raising the inflation target. All of these things stem from the same generic family of models. If we abolish that, what's left at present seems to be that central banks are looking at actual inflation numbers. And the problem with that is, since there are lags in policy, you can be absolutely certain that you'll be too late. So I'm not suggesting that we need to tighten or to ease policy now. I'm not close enough to the numbers to be confident. But I do think that A, we should put money back on the dashboard of indicators. And secondly, we need to be working on a transmission mechanism in order not to fall into the trap of just reacting to the latest inflation number, which means we'll be too late. So
that's a promising set of thoughts, and we'll certainly come back to that. Inflation is always and everywhere a transitory phenomenon. That is very nice. That's line. But let's go to the question of financial stability for a bit. Isabel laid out her thoughts earlier. I'd like to ask Hyun and then Mervyn to talk about financial stability, and if you'd like to directly comment on what Isabel had to say, that'd be great.
Sebastian, maybe I can start and then zoom out. I think when we talk about financial stability, we tend to focus on the intermediary sector, so whether it's about banks or non-banks, NBFI so-called. We do focus on that. But I think it's worth taking a step back and sort of seeing through the intermediaries before we get to them. So we've raised interest rates quite rapidly after a very long period of low for long. And of course, during that time, the notional value of debt has risen. But I think a very important additional element has been terming out that debt. So by terming out, this is a term that the finance people use to describe the fact that borrowers are now increasingly borrowing long term. Just to give you a couple of numbers, if you look at the BIS debt securities for government debt, it started at around 7 years duration, just after the GFC. That's now 8.8. most recently. So we've seen a 2-year increase in the duration.
So that's public debt or all debt?
But this is public debt. This is just on government debt. Now, of course, lengthening duration, turning out is great for rollover. This is what we advise borrowers to do typically. You borrow long term so that you don't have to face the risk of not being able to roll over. But of course, what happens if you borrow long term is that for any shift in the yield, the change in the value of that debt is going to be that much longer. So the rough approximation duration is essentially the percentage increase or decrease in the value of that debt to a 1 percentage point change in the yield. So what that means is, as we've raised rates, there's been this compounding effect. Well, not only is the face value larger, we also have much longer duration. Now, in the case of banks, it shows up in interest rate risk. That's not mark to market, but at least the held to maturity part isn't mark to market. And so, it shows up when you cannot sort of maintain that book value, the valuation on your books.
You're talking about SPV without saying SPV.
And of course, this is what happened to SPV. It's when the deposit was ran, they had to mark to market. That when you realize it. In the case of market intermediaries, of course, they do mark to market, but that's what we call duration. It's the market risk, big changes in market prices. And to some extent, the gilt episode last year is really part and parcel of the same thing. It's a very long duration, and we've seen very big price changes. So I think when we see through that intermediary, we do see these commonalities. But of course, exactly how the stress plays out, exactly what the amplification mechanism is, depends on that sector, depends on that intermediary. But the central bank is also very important here, because when I said 8.8 years, some of that is held by the central bank. And those losses are being felt by the central bank, which is better able to take on those losses. And in a way, what SVB was trying to do was to use the central bank business model when it's not a central bank. So I think it's it's very sobering in that respect. I think when we look at that set of issues, we do see this downside of turning out. It's great for rollover risk, but you're actually feeding in a lot of potential, either for duration risk or for interest rate risk. So what do we do about it? And I'm sure we'll get the Mervyn proposal during this conversation as well. But certainly, I think the fact that, as also Isabel mentioned, the fact that interest rate risk on the banking book is not part of Pillar 1. Pillar 1 being the prescribed capital charges. I think that really, in retrospect, was a blind spot. And it's also sobering to see that many of the banks that have been in the headlines met all the Basel ratios. That's including the Swiss as well. So I think it is time for us to take another look at the set of rules that we have. And you may have seen Pablo Hernandez's recent speech. He's the chairman of the Basel Committee. That there is now a work program that's going to look at these things, including interest rates on the banking book, the FSB work on resolution, and the resolution discussion is also very high on the agenda. I'll come back to Mervyn's proposal later, actually, because I think I should not steal your thunder, Mervyn.
Well, Mervyn, that's an invitation to you, if ever there was one.
Well, first I want to say, the reason we're all here is because of Charles and the work that he did in the Financial Markets Group. And one thing which I remember very clearly when we set up the financial markets group, and Charles moved from the bank to LSE, was that what we wanted to do was to create a research group that would link macroeconomics with the financial system and finance. And I think we felt that in terms of the academic study of these areas, that macroeconomics and finance have gone in different directions, different ways of thinking about problems, which was unhelpful. So we wanted to bring it together. And I think since that point, I've always, every time something's happened in the world, I've been struck by how difficult it is to separate monetary policy from the policies required to achieve financial stability. You can't really, if we made mistakes in the past, it's because we didn't give enough weight to the longer run consequences of financial instability. And we didn't give enough weight in financial regulation to the fact that you can't easily predict when things will go badly wrong. We need a much better, more thoughtful framework within which it could be structured. So that goes back, I think, to my point about having a focus on the transmission mechanism of monetary policy. You can't really assess the risk to monetary policy from the financial system without a greater understanding. And that doesn't have to take the form necessarily of vigorous mathematical modeling. Let me come back then to some of the issues that have been raised. I'm surprised by the numbers on duration that you mentioned, because what's really relevant is not duration of the debt on the government's books, as it were, but the duration of the debt held by the private sector. And with quantitative easing having gone at such rapid levels, the duration of the government debt held by the private sector has shrunk rapidly. It's half in the UK. I'm sure it must be the same in other places where QE has been undertaken. But I think that does affect how one thinks about that. Let me then turn to some of these issues about bank failure. As you say, Credit Suisse met many of the rules that were devised in the Basel discussions after the global financial crisis. That was also true of the banks that failed during the financial crisis. It's quite easy, therefore, to worry that the fact that these rules are not looking at the right metrics. And they're so complex, the capital requirements and the risk measures, that the idea that the measures of risk that people dream up to assess capital requirements based on past data are too often drawn from periods when there wasn't a real problem and don't actually capture the risks that occur when there is a crisis, when often the correlations between assets they're all very highly correlated. Credit Suisse, I think, was a very simple case. It was a bank that discovered an extraordinary number of ways in which it could lose money for its wealth management clients. It was a staggering achievement to find all these different ways in which their wealth management clients lost money. And what brought it down in the end wasn't a bank run of any normal kind. It wasn't the depositors in the conventional sense. It was the clients on the wealth management side who just said, we've had enough, frankly. Don't give us any more good ideas. And the failing was with the Swiss regulator, who simply said, well, the board has to deal with this, and the board didn't deal with it. And there was a lack of energy on the part of the Swiss regulators to deal with a bank that was in deep trouble. You mentioned the resolution process. You need a resolution process to deal with banks that fail. And every now and then, some banks will fail because they made poor judgments. That's true in every industry. We don't want to stop that. What I am struck by in every case where resolution has been applied, that since it's typically the whole point of it is to do it over a weekend, to avoid being thrown into a long conventional bankruptcy procedure, politicians cannot resist getting involved. They did in the case of Credit Suisse, where technically, I'm not a lawyer, and no doubt legal cases in the next few months will tell us the outcome. But it may well be that technically they have the right to impose losses on the bondholders, but not on the equity holders. But the real story, of course, is that Swiss politicians decided that there was much less damage to be had politically from allowing the bondholders to settle than the shareholders, even though that reversed what everyone had understood before was the conventional ranking of creditors. And it's interesting that in the UK case, when the resolution legislation went through the House of Lords, the House of Lords got very exercised about what they called Henry VIII powers. Henry VIII simply arbitrarily took away money from the monasteries. And so the concern here was that the resolution authority, Bank of England, would arbitrarily change the order of the ranking of creditors. But the legislation in the UK makes that unlawful. So both the ECB and the bank, very quickly, what happened in Switzerland, the two big neighbouring central banks stepped up and said, we'd never do that. But politicians got involved, and I have seen cases in the UK where politicians were involved and the resolution process didn't work in the way that it really should have done. Even with SVB UK, HSBC managed to get some of the ring fencing requirements relaxed. That was never part of a resolution process. In the US, they've now found themselves in this very tricky position of saying, we're definitely going to guarantee all the deposits of SVB, but we're not going to guarantee all the deposits of any other bank. In brackets, unless of course something goes wrong with the other bank. So that leads me very briefly to talk about the idea which I wrote about in 2016, which is the idea that you don't want to wait until there's a crisis and find yourself in a position of having to throw a vast amount of money at the problem to prevent bank failures. You've got to do some things to create an ex-ante framework. I call this the pawnbroker for all seasons. Before the great financial crisis, global financial crisis, central banks didn't really lend against any wider collateral. We then moved to a world in which we did lend against almost any collateral. And that's fine, provided you decide what the haircuts are. But you can't decide haircuts once the crisis has started. So I think you need an ex-ante framework in which banks need to have access to a contingent credit line from the central bank. But everyone knows the central bank has said we cannot issue more runnable liabilities, whether deposits or very short-term financing. Everyone's talking about deposit insurance now. In 2008, we weren't talking about that. We were really talking about wholesale funding not being rolled over. The central bank has to replace that, but it must ensure that the regulation is such that the issuance of short-run runnable liabilities cannot be greater than the after haircut value of the assets of the bank, which the central bank can lend against. And that I think would then solve the problem of bank runs. And I think it's an idea you can dress it up in different ways. But that basic principle of the central bank offering a contingent credit line that everyone knows the central bank has decided and is willing to lend as much cash without any questions asked as it needed to meet all the short would, I think, solve the problems of many of the issues that we've seen in recent years. Finally, on the issue of intervention in markets last September, the Bank of England's Financial Policy Committee identified in 2018 the potential problem of pension funds needing to meet cash requirements because they borrowed from other people in the financial sector. They then came up with a proposal for dealing with it, which was to create a liquidity facility along the lines I suggested for pension funds. Now, you can think that was a good or a bad idea, but the whole point of it was to stop the Bank of England from having to intervene directly in the gilts market. And I'm absolutely sure that the bank did try desperately hard to see whether they could put in place a liquidity facility, but not having done it in advance, there was no time for many of the pension funds, many of which are quite small, to put together and go through their own governance procedures to enable them to borrow against collateral from the central bank. the bank had little choice at that point but to intervene directly in the gilts market. But boy, were they desperate to get out. And understandably, because no central bank wants to backstop the gilts market or the market in long-term government debt. They don't know what the long-term interest rate should be. And they don't want to be in a position of having to say, we think this is the right rate. So that's what the bank has now done. It got out of it in time, and it's now put in place arrangements to improve the provision of central bank liquidity to a wider range of financial institutions. And this is going to be a big question, I think, for the future, because we're used to discussing this in the context of bank. That episode raised it for pension funds. It's going to be true for insurance companies. If any government discovers that an insurance company, because it's short of liquidity, is then likely to have to shut down, and 100,000 people will have no insurance policy against car accidents or fires in their house, the government is not going to stand idly by. So I do think that this whole question of to whom does the central bank provide liquidity and how much is probably the biggest issue on the plate for financial regulation. And that's something that we need to spend a lot of time thinking about in the future.
So Shin has already indicated that he wanted to comment on Mervyn's ideas on this. And I want to ask Isabel as well. I think maybe this is just a framing thought, which is perhaps helpful, because it seems to me that in these debates about separation between financial stability and monetary policy, as you've been saying, we've gone through these different phases, and pre-2008, the idea was that the regulation that was in place at the time would deliver enough financial stability that monetary policy could just target inflation. Then 08 came, and that wasn't true. So then there was, some people thought, well, now monetary policy should lean against the wind of bubbles and all that to try to prevent financial instability. But the prevailing view was, don't worry, the regulation failed last time, and now we're going to have it souped up, and there'll be macroprudential adjustments in the dynamic way, and that will work. And so we can still have our monetary policy and focus it on inflation only. And now, listening to Isabel's presentation, the thing that struck me was that separation has come to mean something totally different, which is it means, crisis management tools, which you've improvised on the fly to kind of keep the monetary transmission mechanism, to keep the financial markets working smoothly, whilst, so with one set of tools, you're doing that. They're not ex-ante stability provisions. They are after the fact, fire department interventions. And so you do these on one hand, on the other hand, you're targeting inflation with another set of tools. So it's a different kind of separation, it seems to me. But anyway, I'll come back to Isabel. You can tell me if I'm wrong, but maybe Hyun wants to first of all comment on what Mervyn said.
Actually, Sebastian, maybe I can just follow up on the last point. Yeah, I think it's an incredibly important one. And this actually, in 2001, Charles, John Danielson, and I, and some other people at the FMD, we wrote a response to the Basel II proposals. It was an academic response to Basel II. And the whole point of that was that we should think not in terms of the microprudential institution by institution perspective, but see how the regulations interact at the system-wide level. I think the gilt stress episode, I think is a very good example where rules that are there for good microprudential reasons may nevertheless have unintended consequences. With the duration matching the risk management tool is there for a very good reason, which is you want to ensure the solvency of the institution. But typically for pension funds, but also life insurance companies, the duration of liabilities are much longer than the duration of assets that they have. So there is a convexity mismatch in the sense that the chain of duration is different across the two. And so if you need to adjust, it can often fuel the stress. So when interest rates rise, the duration of both sides of the balance sheet come in, the liability duration comes in much faster. than the asset side duration. So what you find is you have too much duration on the asset side, so you have to sell. Now, the LDI sort of, further fuel because there's also leverage there, but the same kind of effect could happen even without leverage. Even if you're hedging using cash flow, you could still have that same effect. And there's a very interesting study by EIOPA, the European Pension Fund Insurance Regulator, which actually looked at the insurance during the September episode. And what they find is that those insurance companies that hedged using swaps were more likely to sell during the episode. So I think that's one example. Another example might be the use of margining. So typically, the margining can be procyclical if the hedge against credit risk sort of leads you to jack up margins exactly when the stress is highest. But of course, that's when you have deleveraging. I think it's in that spirit that I would actually address Mervyn's proposal, because if you have it pre-positioned and it's at a sufficiently sort of prudent haircut, I think one would have to ask what would happen to the lending in that case. I think that's a situation where the bank would need considerably higher equity than they would typically carry.
Depend on the great virtue of the proposal is that it enables banks to specify whether they want to have long-term risky assets, in which case they can't use much short-term runnable liabilities to finance it as might otherwise have been the case. Or a bank could be an expert at handling customer deposits and payments transmission, in which case they may want a lot of runnable liabilities, then the assets can't be as risky. So there's some constraint, but the key thing is without an ex-ante framework, what happens is that the central bank or the government gets drawn into a completely open-ended and unlimited contribution to providing cash to the bank, which is only too easy to describe, because it is, as a bailout of the banks. The point about the scheme is that it's not a bailout of the banks. It's an insurance mechanism in which the role of the haircuts essentially plays a role of insurance premium. And then if there is, for some reason, a need for cash by the bank, they've paid up initially, they're entitled to draw that down. And it doesn't become a great panic or a major issue.
I think the long-term structural impact, I think, is definitely worth bearing in mind. I think what you're describing, Mervyn, is more of a shift toward sorting out of the banks into narrow banks versus lending banks.
But I think so the danger with just going to narrow banks in the Chicago plan is that clearly, whatever the benefits of maturity transformation, we lose them. We don't have an alternative source of lending which could suddenly overnight spring up. But I don't think, but where we are now is pretty bad, because we have all the risks resulting from bank runs. Is there not some middle position in which, by constraining the ratio of vulnerable liabilities to the central banks forming a judgment how they act on the assets, that seems to me to be a sensible middle ground and removes the risk of bank runs. Because one of the things that also strikes one very forcibly about looking at this is that it's not easy to distinguish between a liquidity problem and a solvency problem. Because if the central bank doesn't provide liquidity, then the bank may become insolvent, even though it's not insolvent if the central bank does provide liquidity. So I do think we need to think again more deeply about the conditions under which central banks provide liquidity. That's crucial to it. And one last anecdote, which I've never forgotten. I actually chaired the governors and heads of supervision meeting that decided on the LCR, etc. at the end. And I noticed that my French counterpart took no interest in this whatsoever. And I was puzzled because they were desperately interested in the capital requirements. So I had a private conversation, and what became apparent was, I said, well, don't you think you should be worried about your banks having enough liquid assets, etc., running short of liquidity? That's what the LCR is all about. Said, no, I'm not really worried about that. I said, well, why? Because if our banks haven't got enough liquidity, we'll give it to them. And whatever else that demonstrates is that you cannot separate the design of a liquidity regulation framework from the rules that govern the provision of central bank liquidity. And I think we should do it in a systematic way, where it's all agreed ex ante. Because the thing that people forget about Badger and the lender of last resort is that Badger was absolutely clear that you couldn't have any ambiguity about it. It had to be very clear that people understood that what would happen. And the only way we can do that is by designing a proper ex ante framework.
Yes.
So actually, I have a couple of comments on, especially what Mervyn said. So let me start with transmission. I mean, of course, a lot has happened in the models. I mean, it's not that the models don't have anything on transmission. Actually, the Financial Markets Group contributed to starting this whole research agenda, which has, of course, tried to integrate the financial sector into the macro models. And I would say, I mean, enormous progress has been made. I agree with you. We are not there where we maybe want to be and need to be. But so at least at the ECB, we look very closely at many issues related to transmission. And by the way, we also look at money. So we have something, I mean, one part of our analysis called the monetary and financial analysis. And what this does is we look at money and we look at transmission. So it's not that we are fully ignoring it.
The ECB is the only central bank.
Okay, maybe, but I don't know. I would be a bit surprised because it's, I mean, that's what in I don't know, current research is of course have moved very strongly in that direction. I mean, on the models, I mean, of course, it's perfectly right what you're saying that they have this inbuilt feature that they return to 2% because you have, I mean, a credible central bank. But of course, the people using these models, so my colleagues in the Governing Council and me, I mean, we know that. It's not that we are, you know, taking these models as an absolute truth, but we are aware of the weaknesses. Just that we are aware of the fact that by looking at current inflation, then there is a tendency to be late. So, but you know, there is not the perfect, we don't have the perfect information. So what we do is we look at the model, we are aware of the weaknesses, we look at the current data, which also helps us to improve the models, because we, for example, we saw very much that one weakness of the models was that they completely underestimated persistence. And so, I mean, the teams, I mean, they have been working a lot on improving that, on understanding better how energy prices are being passed through into all these different parts of the economy. And I mean, it's just very difficult, but what we try, so we don't religiously rely on the models, and we neither religiously rely on the current inflation data, but we take all the information we have, and then we use, of course, our expert judgment to make sense of all of that. And there is a lot of uncertainty, as you know, very, very well. And of course, we have put less emphasis on the models recently because we were aware that there were so many structural changes in the economy. And for that simple reason, the models could not be as reliable as in a very stable episode. I mean, so many things have changed with the pandemic, with working from home, with the geopolitical changes and so on. So these are fundamental shifts that are very hard to model. But of course, we know that, and we somehow have to factor that in, and not necessarily into an all-encompassing model, but just into our judgment. And that's the way, I mean, I would see that. When you propose, I think it's very, very interesting. I have one question. So I was showing you this graph on the rate expectations. And so imagine now we are in December 2021. And I mean, when we talk about haircuts, we normally think about credit risk, but basically we would also have to factor in interest rate risk, no? So how would you deal with that? So at that point in time, you know, central banks, market participants, everybody believe, okay, rates are probably going to stay low. So how would you, and then we saw interest rates went up massively, which, I mean, had an effect on the market values in the order of 20%. So if we had, I mean, I'm pretty sure if we had pre-announced haircuts, they would most certainly have been too low. And we have ended up bailing out the banks via this proposal, which is meant to not bail out the banks. Because it's very hard to capture this interest rate component, but and in addition, we would even be sending kind of signals. I mean, if we had said, okay, we have to increase the haircut because we may raise interest rates, we'd be sending signals, sending the haircut. So how would you deal with this type of risk? Because that is the one that we're talking about now, not so much about credit risk.
So the risks, the haircuts need to be kept constant for a number of years. You don't change them at the drop of a hat. And interestingly, one thing which the Fed did sensibly by introducing the bank term funding program, which was criticized because it basically said, we're not going to impose a haircut on holdings of government bonds, we'll lend it at par. That's exactly what will happen in the scheme that I proposed, because the point about the central bank is that they can hold assets which they take as collateral if the bank fails, and be very patient for that. And they can hold it to par. There'll be absolutely nothing wrong with the central bank lending against government bonds at par, irrespective of what happens to interest rates if they make that decision. But you need to do it in an ex ante framework, not an ex post one, which is, I think, they've done it. They ought to try to integrate this as part of their normal operations now, not just regard it as a one-time thing. And when you're saying haircut for a long period, yes, it will be more conservative. But you know, in the late 2010s, the idea that interest rates could go up could hardly have been a surprise to me. I mean, this was something that was always on the cards, and you'd expect it to be factored into the value of the collateral against which central banks would lend if it was private collateral. There's securities, financial securities issued by the private sector. And that's one of the roles of the central banks to think about those things. But you know, the mistake with this we've been made was not to hedge the interest rate risk, which they could have done, and most other banks did. Not necessarily that it was a mistake to buy those assets, but it was a mistake not to hedge their own risk. But there's no reason why the central bank couldn't say we are willing to lend against the holdings of government bonds at par.
We're about 10 minutes off the schedule then, so I promised to get questions. So who's got the desire to intervene, interrogate? Yes, over again. Yeah.
Rather strong.
Wait for the microphone. It's coming.
I think a lot of people watching the recent,
Catherine
Tyson. I think a lot of people observing the recent bank failures and resolutions were shocked by the rate of innovation against expectations. I mean, you've already mentioned the bank term funding facility, which breaks every rule of budget of lending against good collateral at discount at discriminatory rates. Instead, they're lending at 100% par at very beneficial rates. And the other innovation coming out now that will be rolled out next year in an election year is treasury buybacks. So the treasury will buy back underwater portfolios that hold to maturity, who knows how generously in an election year, and make good bank balance sheets that way. Because the PTFP program is only for 1 year. With the Swiss, we saw legislation against all expectations being written on Sunday with no consultation, passed in a very undemocratic way, and stripping shareholders of every expected shareholder right, both by both the acquirer and Credit Suisse, and then with First Republic, we've seen even further innovations in the treatment and the resolution. I mean, we now have a system where 99% of deposits are covered by FDIC 250,000 standard provision, and yet it's billionaires being bailed out. So it seems to me that there's a real gap between the thousands and thousands of hours that were spent negotiating Basel III and the treatment that we're now seeing on the ground as admittedly, supervisors are taking very difficult decisions on the fly over a weekend. But it does seem to me that there's a gap between law and expectations, and if that widens, it becomes very dangerous.
I think this goes to the heart of what I talked about with ex ante versus ex post. Take your point about resolution and rights of shareholders being overridden over the weekend. The resolution framework, which is passed by Parliament, either would or would not have in it explicit power for the resolution authority to make decisions about what happens to the bank assets. And it may be that Parliament decide that they want to give the resolution authority the powers to make those decisions. What you don't want is a new power being dreamt up and exercised without any discussion or approval by Parliament. And that's why I think an ex ante framework is very important. After the global financial crisis, the US authorities ended what they did by saying, in a crisis, you have to throw as much liquidity on the fire as you need to douse it. And if you don't think about the problem until then, that is true. Otherwise, you've got a collapse of the banking system and the economy. But that's not good enough. You need to think before the crisis about what are the limits to the extent that you are prepared to go. And I think the whole point of the schemes, which I know many people are now thinking about, contingent credit lines from the central bank, is in order to limit the size of the liquidity that you have to throw on the fire. But if you don't throw it on the fire and the crisis has started, then you could be in deep trouble.
There's one more question over there, and we say, if you haven't seen this, and then how will you?
Thank you, Hugh Vancinis. I think we're all here because we've benefited from Charles' wise counsel. Charles once told me that every monetary policy committee should have a member on it who had a real world understanding of financial plumbing. So I suppose first, would you agree? And second, do you think the Fed would have done a better job spotting the bank runs if it had a plumber amongst the PhDs? Thanks.
I think, yeah, go ahead.
Certainly, knowledge of plumbing is very important. And you know, when we were writing this report on Basel II, that was one experience where we certainly. I'm only going to speak for myself, but John Daniels also, I'm sure, learned a lot. We haven't talked about credit risk, Sebastian, and we haven't talked about what we should expect as we look ahead. We are sort of picking apart the entry right now as if it's at the end, and we're now in the waters. The shoe that hasn't dropped is credit risk, but historically that always does. And I think that's the next chapter that we need to be very, very vigilant about. And so, interest rate risk has been very much at the front of our minds. But as we look ahead, it's not uniform across all jurisdictions. But in those countries that have very high household debt, for example, and housing markets are very buoyant. Countries with lots of corporate debt, and also depending on the type of structure, there's been a shift towards more opaque forms of lending as well. When I sort of made the point about let's look through the intermediary, I think we haven't really talked much about private debt and the similar problem that could be there, but I would say let's not treat this as a kind of a post-mortem. I think this is something that's still ongoing.
It sounds like your answer to Hugh's question is yes, we need financial plumbers because the shoe hasn't dropped.
Well, I wasn't there like, I don't know, 20 years ago, but nowadays we do talk a lot about plumbing. So that is what I noticed, that this is playing a relatively important role in the discussion. So that gained importance, and I certainly agree to the statement.
Yeah, I think you raised an important question here. I mean, when the Monetary Policy Committee was set up in 1997, there was a group of people with very different backgrounds and experience. That enabled the conversation in the committee to take the form of you know, well, aren't you overlooking this, or I don't know much about that, what do you think? And I can only think of one member of the NPC since then who has felt that the committee could operate perfectly well by never meeting. You know, just sitting at home and submitting your decision. But the conversations on that committee are very important. And I do think we're at risk of having moved to a world with much less diversity in thinking. You know, what I worry about is that the focus on diversity of gender and ethnicity is being given prominence, which ought to be given to diversity in thinking about our monetary policy work. The other point I'll make about this, I think, is that you know, well, as talked about, you think more about the funding, but that's partly now, I think, because central banks have reverted to an older world in which discussions about financial regulation, financial stability, even if they're conducted on different committees within the central bank, they are part and parcel of the same institution. And I think that has improved one's ability in central banks to take these things into account. At least some people sit on the road with different committees.
Well, with that, I think it's now time to celebrate the Charles Goodhart Library. So thank you, everybody.